What's going on, everybody? Welcome back to our series, Becoming an Apex Trader, the DBT method. In today's episode, we will be talking about market structure. Now, this is a 5-part series. The first episode was on candlesticks. Today, we're going to be talking about market structure. Next episode, we'll talk about indicators, and then volume profile, and then close it up with order flow. Now, a quick recap before we get started. Make sure to get entered in our giveaway for Apex accounts, Addis accounts, Discord access, and a laptop giveaway at the end of the series. If you guys want to get entered, just follow what you see on the screen, and we will be pulling those giveaways on our Q&A live streams and throughout the series. Okay, before we get started with market structure, let's go ahead and have a quick recap of what we talked about in our last video, candlesticks. We talked about the anatomy of a candle, the types of candles, reactive candles, viewing candles as a cluster, and also viewing them as a zigzag, not zooming in too much to each individual candle. Now make sure before you watch this video, go back and watch our candlesticks video, or if you understand these concepts, let's go ahead and get started. So starting off with today, we are going to be talking about market structure, higher high, higher low, lower low, who's in control, types of trades you can take with market structure like rollover trades, sweep trades, and finally we're going to close it up with advanced structure using volume profile, which obviously that part of the video will make more sense once you've seen the series as a whole and you come back to this video. But if you already understand my volume profile concepts, you will enjoy that part of this video. So starting off with our structure basics, what are we looking for with market structure? Basically, when you're looking at a trend and you're seeing the clusters of candles get taken out to a new low or taken out to a new high, as we talked about in our first episode, those clusters of candles, not just the individual candles, we want to see really who is controlling that trend. Are we continuously putting in lower lows? Are we continuously putting in lower highs? Are we starting to shift that structure? Were we putting in lower lows the entire way down, but now we're putting in higher lows? Now the clusters are going at a higher price. We are shifting that trend back to a bullish trend. We're going to get into some key examples of this later in the video. So one thing I wanted to talk about is, I always talk about on stream, like who's in control. And I'm always referring to aggressive or responsive. What am I talking about when I talk about aggressive and responsive? There's 4 types of markets that you typically see. Well, 5 types if you include the neutral type. But you typically see bullish aggressive, bullish responsive, bearish aggressive, bearish responsive, and then that 5th type, that neutral type, where you're not really in one of these 4 types of a day. Now, typically with a bullish aggressive day, those are those very strong uptrends, those trends that you just can't really seem to get a pullback. You can't really seem to get a late entry if you missed that explosion to the upside, that breakout to the upside. The prior bar lows are just continuously being protected as you are pushing higher. You basically just cannot find an entry unless you are being a breakout trader. Now, the bullish responsive trend, the one on the top right here, this would be when you're trending up, but it is giving you those pullbacks. It's pulling back to like the EMAs, pulling back to the prior support or resistance levels, but you are still trending up. It's giving those responsive traders an opportunity to get in that trade, to get in that trend, but that trend is still remaining bullish. It's not completely flipping to the downside. Now, in some instances, people would say that's just profit taking, right? The sells that are coming down and pushing you back to that lower trend line or pushing you back to that prior high or prior low support, those are just people taking profit on the way up, but the sellers are not fully in control. The buyers are still in control. You just have a little bit of sell pressure that keeps kind of pushing you back down. Then you have the bearish aggressive side, which is obviously the opposite of the bullish aggressive, where you're just selling continuously. And you just can't really seem to find those pullbacks to get in a late entry. Either you shorted when it started exploding to the downside, or you're just sitting on your hands and you're waiting for another trade. If you guys use my EMA technique, which we'll talk about in the indicator series, the third video in the series, when you're holding below that 80 EMA continuously and you're just not bouncing back to those more responsive EMAs around the 20s, like 20, 21, 24, somewhere around there. You're just continuously breaking the prior bar lows and you're not really taking out the prior bar highs. This is something we'll get into later in the series on volume profile when we talk about one time framing. It's basically when one side of the candle is continuously being taken out, but the other side of the candle is not being tested or broken at all. So in this case, in a bearish aggressive market, you're going to keep breaking those prior bar lows and you're not going to break those prior bar highs. Now, finally, we have the bearish responsive, where we have that downtrend, but once again, there's a little bit of profit taking. There's a little bit of buy pressure coming in that's pushing you back to that upper trend line. You're kind of testing prior bar highs, possibly even breaking them, but overall, your trend is still bearish. The bears are still in control, and you are still looking for lower value. It is allowing a couple bounces here and there, but if you're trying to look for those big buys that go back to like high of day or value high or somewhere around there, you're just not getting those. You're only getting small scalps on the buy side when the sellers are getting pretty much everything they want to the downside. Now, last but not least is the neutral, which is basically when you don't see any of these patterns. It's just a sideways market entirely. You see that very often in a D-shaped balance, which obviously we'll talk about in the volume profile video, but it's when you have that back and forth market where you are taking out the prior bar highs, you're taking out the prior bar lows, you're seeing sweeps all over the place, but you're not really seeing one side being in control. Whether they would be in control aggressively or responsively, it doesn't matter. Neither side is really showing that control at all. It's a very 50-50 market. So moving on, what type of trades can we look for in these market structure shifts? We can look for rollover tops, rollover bottoms, and we can look for sweeps. Now, obviously, there are many of other trading techniques that you can use with market structure, but these are my favorite ones that we're going to talk about today. I'm going to show some exact examples later in this video. And finally, for advanced structure, we're going to talk about using a failure to rotate and an incomplete auction, which obviously is going to make more sense when you understand my volume profile techniques, but using this can be very powerful in your trading with market structure shifts. All right, let's take a look at some examples here. So starting off with the basics, higher highs, higher lows, lower lows, what are we talking about? If you guys remember from my first episode in this series talking about candlesticks, we talked about viewing the candles as clusters, kind of like zones of candles, and viewing the market as a zigzag, right? Where we just find those clusters and we just connect them together, right? So you just continuously find these clusters of candles and you just connect them together and you try to figure out, are we putting in higher value? Are we putting in lower value? So the market likes to do two things, right? It either likes to sit in a value range, which we'll talk about this obviously a lot more in our volume profile video, or it likes to find higher value or find lower value. So basically ranging and impulsing. I talked about earlier aggressive versus responsive. So typically when the market is liking a range, when it's liking a certain node or a certain value, that market will be very responsive. If the market wants to find higher value or find lower value, then it wants to be more aggressive. You have these impulses during the aggressive movement. You have these ranges during the more responsive movement. So basically what we want to look for when we're looking for higher highs, lower highs, all that stuff, we want to be finding where those impulses are creating levels, right? Where they're creating those highs and lows, And then when we start to kind of bounce back or chop back from that impulse, is it putting in a higher low? Is it putting in a higher high when it's going against that impulse? Or is it putting in a lower high? Is it going with the trend, right? So for example, like we have this impulse down, we can go ahead and say that's kind of our point of origin. We can take that little cluster there. And this is kind of where that impulse bottomed out. We can take that point of origin as well. And then when we start to push away from that price action, we start to push away from that cluster, what are we doing? We need to pay attention here. Are we putting in higher lows? So do we start to put in big clusters of value, big clusters of candles above that higher low? Or are we just immediately breaking back down from that low and putting in a lower low, putting in another cluster of value below that cluster where we started to bounce, right? So we want to compare these clusters together. So in this case, let's just do a quick little recap of what we see on our screen here. Let's say we have a breakdown here. That's where the impulse starts. We put in another cluster right here. And then we start to have this little cluster right here. It's kind of a U shape. So that I would call a higher low because you're putting in a little bit of a buy pressure above that prior low. And this continues for a little bit, but what do you not see here? If we're marking out this as kind of where the impulse started, if you guys remember in the first video, we talked about points of origin. We don't really see a higher high from that point of origin. Now you could argue that we see higher highs locally. It's kind of in a local uptrend, which is kind of a bear flag, right? It's a local uptrend inside of an overall downtrend. So we have a little bit of a local buy pressure here. You are putting in micro higher highs, micro higher lows, but the overall impulse that started pushing us down is not being threatened. That high is not seeing a break to put in a higher high. So overall, once we start to see those lower lows, or excuse me, the higher lows, once we start to see those higher lows get taken out, then that overall trend is still in control, and you might start seeing the aggressive traders come back in and push that down. Okay, so just to recap very quickly, we had the impulse starting right here. We put in that low. Locally, we are putting in higher highs by breaking these little highs. But overall, where that impulse started is not seeing a higher high. So overall, the bears are still in control. Now, this would be something that I refer to as kind of bearish responsive because they are allowing it to come back a little bit. But once those lows get taken out, then you see the aggressive traders start to come back. And then this is a key point here. When we start to look for these clusters of candles, you really want to pay attention when you start seeing those market structure shifts from responsive to aggressive, right? So responsive, yet again, you have that kind of choppiness, but then aggressive, you have that impulse. We talked about in the first video, when you have that shift, we want to look for that point of origin. So same thing here. We start to shift from this kind of choppy responsiveness into aggressive sellers. The aggressive sellers are coming back. We know they're aggressive because look at how strong those candles are. When you have these giant engulfing candles, that is very obviously aggressive. So one thing we can take note of here is obviously the point of origin, like we talked about before. But also, let's pretend like we are in, let's say we shorted for some reason. If we shorted up here and we were in this trade from this impulse and we were not trailed out on this pushback. When we start to push away from these clusters, then you can start to pull your stop loss, right? You don't want to pull your stop loss during these choppy value ranges. But when it has that aggressive push, we could look to pull our stop loss. So let's say we're shorting and we start to push aggressively away from that cluster, then after that impulse, we are safe to pull our stop loss above that cluster. If we try to pull our stop loss during the cluster when it's chopping around being responsive, we're basically just asking to be stopped out because it's too choppy to determine where that kind of wall is that's going to protect us, where that level is, kind of like the point of origin like we talked about in the first video. When you see that aggressiveness pull away from that cluster, then we can say, okay, that's kind of where we want to put our stop, where that origin is. We can use that as a resistance for our short. Now, the same thing would be true to the buy side. Look at this cluster right here. So we have this cluster, and then we have this very obvious market structure shift because we went from a lower high structure into a higher high structure. They started breaking those highs with aggressive buy pressure. So now that we started to push away from that cluster and shifted our market structure, then we are safe to move our stop loss. So let's say we were buying down here for some reason, and we were looking for somewhere to pull our stop loss. Once we broke away from this cluster, we could pull our stop loss. Now, obviously, this is not like the best example. It's not a great way to move your stop. I'm just talking about the bare bones market structure shift as your stop loss trail. So that is when I like to use these clusters when I am shifting my stops. Once that cluster has been pushed away from, once the aggressive traders have accepted or rejected that cluster. Okay, very quick recap here. Just identify the clusters of candles, connect the dots between the clusters of candles, and see, are you putting in a lower value or are you shifting your value? Is the value now going to a different direction, right? Are the buyers taking control when the sellers were initially in control? Okay, let's take a look at some weird examples of this type of shift. So you guys hear me talk about on stream very often vertical distributions and downward accumulations. Now, these would be what I identify as the responsive type of market, where the aggressive traders are not really getting what they want, but it's still trending in that direction. So the buyers are in control, but you can't just be a breakout buyer and just be like, oh, I'm just going to buy the breakout of the high. It's an easy uptrend. I'll make money. It's not going to work, right? In a responsive market, you need to buy on the pullbacks if you're going to buy at all. Now, these types of days, these responsive markets where you're in a vertical distribution or a downward accumulation, being a trader at all is kind of risky. The buy side is very risky because you can see that stairs up, elevator down type of pattern. The sell side is very risky because obviously the trend is still going to the upside and they are ignoring the sell signals. They can typically show a lot of sweeps or rollovers, which we'll get to here in a little bit, but it will ignore them. So when you have the responsive days where it's trending in one direction, but it's not doing it very aggressively, protecting every single prior bar low and just breaking every prior bar high, if you're doing it responsively, it's going to ignore a lot of signals that normally would be like, oh, that's a really good signal. Let me press the short button. It's just not going to work on these types of days. So one thing you want to look for on these responsive days, this would be an example of a vertical distribution because that would be obviously to the upside, vertical meaning up. So 24 EMA is tested or breached multiple times during this trend. And also the breakout buyers are not getting any momentum. These are the type of days where you're like, you're seeing the uptrend. You're like, okay, I'm just going to press the buy button on the breakout. And then you're like, wow, how did I lose that trade? And you try again and you lose the trade again. You're like, how am I losing when I'm being a buyer in an uptrend? It's because it's probably a vertical distribution and the breakout buyers are not in control. You need to figure out not only what side of the market is in control, but what type of trader on that side is in control. So is it bullish or bearish? Okay, that's good. Is it aggressive or responsive? Because if you're being a aggressive bullish buyer, which are basically breakout buyers, in a bullish responsive day, it would look like this, where you're buying those breakouts and it's just simply not working. So be very careful when you see that 24 EMA or just like the pullback areas. You don't have to use the moving averages, but if you're seeing a lot of pullbacks to like prior bar lows, prior bar highs, then the responsive traders are probably in control. The limit buyers are in control, not the market buyers. Here's an example of a bullish aggressive. Notice the difference in the candles. You see how strong these breakout candles are? You see how the prior bar lows are not being taken out? You're breaking the prior bar high and you're not testing or getting anywhere near the prior bar lows. And even if you do, you are staying above the aggressive average, which in my case is the 8 EMA. I like to use the 8 EMA and the 24 EMA. The 8 EMA is the aggressive side. The 24 EMA is more of the passive side. And I'll talk about more of that in the next video on indicators. But basically, if you're staying above the prior bar highs, if you're breaking them very consistently, if you're staying above the 8 EMA, then you're a little bit safer to be a breakout buyer. You don't have to wait for those pullbacks into the 24 EMA or the prior bar lows. And maybe if you were waiting, you're not even going to get a trade anyway. So on these type of days, those are the days you really want to be a breakout buyer or possibly just sitting on your hands and waiting for a shift. Another example that you'll see on these type of days where it is aggressive, but every now and then you will see a pullback to the 24. That is not what I would call a responsive day. It is still aggressive. They're just giving it like one pullback, right? Where you have that very aggressive breakdown. The prior bar lows are being taken out consistently. You're obviously putting in lower lows. You're obviously putting in lower highs. The highs are nowhere near the prior structure high. It is very clearly bearish. Now, just because you're pulling back and you're breaking the 80 EMA by a little bit and you're testing the 24, that doesn't immediately mean that you're going into a responsive market. What I mean by a responsive market is when you're seeing it continuously. You're constantly pulling back to the 24. You're constantly breaking the 24 or the prior bar lows. You're going against that prevailing trend more often. Now, obviously, that trend is still winning, but you're going against it more often. So right here, this would still be aggressive. Notice how almost every single candle is staying below the aggressive average, which is the teal line here, the 80 EMA. It basically tells you that, hey, if I'm waiting for a pullback trade, if I'm trying to look for maybe a pullback to VWAP or a pullback to the 24 EMA, you're just not getting it. You might have had one opportunity if you got lucky, and it might have front ran it, but you're just not going to get your pullbacks. You have to either be an aggressive breakout trader, or maybe the only pullback you're going to get is like the 80 EMA pullback, the very aggressive pullback where the sellers are just going to keep pushing it back down. That is basically the lightest form of profit taking. When you have those traders that are winning their trade, they're taking profit. Remember, if you're selling and then you're closing the trade, you have to be a buyer, right? So you have to have these little buys coming in every now and then if the people shorting want to get out of their trades. So every now and then you're going to see these little pullbacks of the 80 EMA, maybe the 24 EMA. That doesn't mean the structure is shifting. It just means there's a little bit of profit taking. Okay, so you see that little bit of profit taking into that 80 EMA every now and then, but the aggressive traders are still in control. Okay, so a quick tip is just if you're testing the 24 EMA, if you're constantly testing the opposite side of the prevailing trend, meaning if your trend is bearish and you're constantly testing the prior bar highs, then you're probably in a responsive market where it's allowing a lot of pullbacks, but it's still trending to that side, right? It's still bearish, but it's allowing the opposing side a little bit more than it probably should. But if you're not allowing that and you're not allowing the prior bar highs and you're just continuously breaking down, then you're in an aggressive market. All right, moving on to what you guys have been waiting for, the actual types of trades we can look for with these shifts in structure. So one of my favorite trades to look for is a sweep trade. So a sweep in the simplest form is when you are breaking a level. It can be any kind of level that you like high of day, low of day, value high, value low. It could be the prior bar high, the prior bar low. You're breaking that level, but then you are retracing to the other side of that level. So in this case here, we are breaking that prior bar high, but we are sweeping back to the downside. A sweep is almost always the start of a market structure shift, where if you keep seeing these sweeps, think about what's happening. You are breaking into a higher high, or you're attempting to, but then it's failing. So if you're in a uptrend, higher high, higher low, higher high, higher low, you break that higher high, you put in that level, but you sweep it, you come back down. That is that trend weakening, because you are identifying that that higher high is now flipping into a little bit of resistance, not support. Okay? So if we take a look at that, and we're like, all right, with that said, how can we trade that? So normally, what we want to see is we want to identify that sweep level, and let me be very clear. We normally want to identify that sweep level on a 30-minute time frame. We can go down to the lower time frames to see what that market structure shift is looking like on like the 5-minute or the 1-minute. Are we actually starting to put in those clusters of candles, those obvious lower highs, in this case because it's a bearish sweep? Are we putting in those lower highs and possibly lower lows? But to identify the actual sweep level, we do want to be doing that on a 30-minute time frame. That is what time frame I found is best for those trades. So once we identify that sweep level on the 30-minute, we can go down to the lower time frame and start to look at that market structure. Are we putting in those lower highs? And we also want to identify where our stop loss would be. And typically in this trade, your stop loss is above wherever that sweep started to flip its structure, started to flip its buy or sell pressure, right? So once that buy pressure came to an end and we started to flip back to sell pressure, the high of that candle, we want our stop loss to be above it. Now, how much above it, it really depends. It really depends on the market volatility. Are there other levels in that general area? It really depends. I can't give you guys a set in stone. It's going to be 3 points or 5 points. I can't really tell you. It's going to be based on the volatility. But you want it to be above that level, just not too far away. Now, once you identify where your stop loss should be, once you identify where your general target should be, and your targets can be many things. It can be prior value levels. It can be point of origins. It can be prior 30-minute bar lows. I mean, anything. Targets are really kind of up to the trader. There's no like set in stone, I always target this. You want to be looking for prior value. In this case, it's a bearish sweep, so we want to look for lower value, right? Those lower value levels. Okay, so once we've identified our stop loss, our sweep level, and where we are targeting, we have to identify where our optimal entry point would be. Now, always during the sweep, the best point to enter is the actual sweep level. Once it has come back down and swept whatever that level is, whether it's the prior bar high or the value high, whatever, right? Whatever level you are using to identify the sweep, that is the most important, the most optimal entry point. Now, you could also say there's a little bit of a zone around that sweep level. Now, where that zone goes to is kind of up to where your stop loss is. Now, I typically say anywhere from 1.5 to 1.25, like 1.25 to 1.5 risk to reward is optimal for these trades. Let's say if you're risking $100, you want to make $125 or $150 on this trade, 1.25 to 1.5. Now, I've seen people where they're like, okay, I understand the risk to reward thing. I can just move my stop loss to make that risk to reward match what I want it to. I want to have a 1.5 risk to reward in this trade. Let me just move my stop loss and adapt to that risk to reward. That is not what you want to do. You need to identify where your stop loss should be first. Then you can say, okay, based on where that stop loss is and based on where my target is, this is where I can kind of enter. You don't want to pull your stop loss to make your risk to reward make sense, because then you're just putting your stop loss in an area that is easier to hit. And basically what you want to be thinking about when you are taking any kind of trade, not just a sweep trade, is the probability of my stop loss being hit higher than the probability of my target being hit? If the answer is yes, your trade is bad. You want the probability of your stop loss being hit to be lower than the probability of your target being hit. Okay, that means the trade is good. That means you have a good chance of success. Now, obviously, these probabilities are hard to determine. We're not robots. How you'll determine that is by taking the same trade over and over and over again and kind of journaling and figuring out, okay, if I do this, I have a 60% win rate. If I do this, I have a 40% win rate. That sort of thing. Okay. I can't give you guys exact numbers. You'll have to kind of journal that out. But long story short, you do not want to just pull your stop loss to adapt to whatever risk reward you want. You need to identify where your stop loss should be and keep it relatively there. So with that said, if we take a look at this, there's a couple of profit and loss boxes here. We have the 1.53 risk to reward, meaning if we took this at the sweep level, if we shorted at that exact level of that sweep, and we put our stop loss above the high, and then we targeted that prior low support, we would be getting a 1.53 risk to reward. We would be risking 4.25 to make 6.5. If we put our entry at the lowest I possibly would enter at a 1.25, we would be aiming for 6 points. We would be risking 4.75. So the optimal entry point would be, if you wanted to say the very, very small zone, it would be from the sweep level here down to where that level is right there, 68.05. Now, why I drew this entire box is because sometimes during a sweep, you will see what's called a wick retest, where you swept the level, but then you started to come back and you retested that wick. So you could argue that your optimal entry is that entire wick retest, because you would still have more than a 1.5 or a 1.25 risk to reward. It would actually be better than that. So if you entered somewhere around here, kind of in the middle of the zone, and you kept your stop loss where you identified as a good level for it to be, and you still targeted the same prior low support, your risk to reward would go up, because your profit is going up, but your stop loss is going down. How much you're risking on your stop loss is going down. Okay, so that's why I drew the entire box and not just the very small box from where the sweep level is to where your risk to reward no longer makes sense. Okay. And obviously this looks like it's going to take you forever when you start to trade. You're like, how the hell could I trade if I'm taking 10 minutes to draw all these boxes and figure out my exact risk to reward ratio? When you get used to it, guys, it really does not take that long. You can do all this in your head pretty quickly. you'll get to the point where you're doing it in like less than 30 seconds, less than a minute. Obviously, if you're like actually drawing out every single level, it's probably going to take you a little bit longer, but you'll get to a point where you can do this in your head pretty much right away. Okay, so that's for sweeps. We're going to move on to rollovers. So for rollover tops and rollover bottoms, we are looking for a couple of key things. For a rollover top, we are looking for a strong impulse up. We want to see those buyers start to weaken. What I mean by weaken is it kind of shifts more into a responsive market. So earlier I talked about testing those prior bar lows, testing the 80 EMA, 24 EMA, that sort of thing. When you start to see more of those pullbacks, those weak highs. What do I mean by weak highs? Remember how I talked about in the vertical distribution when you have the breakout of the high, when you're in a very obvious uptrend and you're being a breakout trader on the high, but you're just not getting what you want? You break that high, but then you come back right away. That's a weak high. When you start to break into new highs, but it barely finds any value, and then it pulls back. Look at the difference between breaking these candle highs, very strong momentum. Breaking these candle highs, very strong momentum. Look at what happens here. You break those candle highs, pull back immediately. Break those candle highs, pull back immediately. That is a weak high. If you're breaking out, then the breakout trader is failing, pulling back immediately. That is weak. You want to see the momentum when you are breaking a level. That is aggressive. Okay. So with a rollover top, we want to see that impulse up. We want to see the weakening buyers. We want to see a weak high or a sweep. This is an example of a very small sweep. You just barely break that level. Sometimes you'll see a very large sweep that will have like delta absorption and all kinds of other stuff we'll talk about later in the series. But realistically, as long as it has a weak high or a sweep, it's okay. And then you have a lower high. So the market structure is shifting from a higher high and higher low market into a lower high, lower low market. Okay? So remember with the sweep trade, we talked about getting in that optimal level, that optimal point where it's kind of sweeping, that exact sweep level or really close to that exact sweep level. If you miss that trade, if you miss the sweep trade, your last opportunity to take that trade is a rollover top or a rollover bottom. Because what's happening is the sweep, if you guys remember way back at the start of this video, I talked about how sweeps were the warning sign. They were the first signal that your market structure was beginning to shift. That's the warning sign. Then the actual shift happens. Then you have the higher high structure turning into a lower high structure. So that lower high coming in is identifying the market structure shift that you can take as your short trade. Okay, strong impulse up. Buyers are weakening. There's the sweep. If you missed the sweep trade, maybe you just weren't paying attention or whatever, you can look for that rollover top. It looks like a rollover, right? It's kind of a curved top. That lower high is confirming that there is a shift in structure. There doesn't always have to be a lower low before that lower high, but if there is, it's just kind of telling you that the market structure is shifting, right? Higher high, higher low, into a lower high, lower low. Let's take a look at this in more detail. Okay, so with what we just said, we can identify that sweep level. This is the same chart, by the way. Same exact chart. So we have that sweep level on the high, just barely, very small sweep. We broke that level by just a little bit, and then we came back down. If you missed this sweep entry, we have that lower high right here. How do we identify where the optimal entry zone is for this trade? So we know that we're not being too early. We know that we're not being too late. What you want to look for is obviously The sweep level is the most optimal. If you were able to catch that, that is the best place to take that trade. But where else can we take that trade? You want to look for where the buyers are stepping in. So typically before that sweep, before that rollover, there is going to be some buy pressure in that general area. So we want to identify where those buyers are stepping in, and that is kind of the bottom of your optimal entry zone, because you don't want to be selling aggressively when there are obvious responsive buyers trying to hold that market up. Okay. Your stop loss is above the high, like we talked about earlier. Where above the high? That's kind of a variable. It depends on the volatility, depends on other levels, etc., etc. But you want it to be above the high with enough room where you don't just get hunted. You don't see those wicks that just pop up and then stop you out. Give it a little bit of wiggle room above the high, and make sure you are getting a 1.25 to 1.5 to your profit, right? Your risk to reward ratio. And technically the way that I say it, it's probably reward to risk ratio, but you guys know what I mean. And for targets, we're going to talk about this more so in the indicators video when we talk about like VWAP and whatnot. But typically with a rollover top trade, you are targeting VWAP. Typically VWAP is going to be below, and you'll target that. And then point of origins. So we talked about point of origins in the candlestick video. Those are always great levels to target for these rollover patterns because there's usually an impulse before the rollover. Okay, moving on to a rollover bottom. This is pretty much the same trade. You just flip it to the buy side. We had a very obvious market structure, a bearish market structure, excuse me. We had lower lows and lower highs. The clusters of candles are obviously looking for lower value. Those clusters, if you connect the dots, are going lower. They're putting in lower highs and lower lows. But we start to get weak on the bottom here. We start to see these little sweeps happen. So we want to identify, obviously, the sweep level. Where are these sweeps occurring? So on the bottom here, we start to see that buy pressure come in. We break the bottom, but like we said earlier, it barely broke. If you were a breakout seller here, you did not get what you wanted, and you pretty much lost that trade immediately. So it puts in a weak low. That weak low turns into a sweep because you break that prior low and then you reclaim it. So we identify that as the sweep level. We want to identify nearby where are the sellers coming in. The sellers are coming in around this level right here. We can see it's pushing us down. We bounce. It pushes us down again. That is where the sellers are coming in. Okay. So once again, the most optimal entry would obviously be the sweep level if you were able to catch that. But if you weren't able to catch that level, typically the sweep levels are very fast. You have to be watching it like a hawk to get in that trade. If you want to get in another trade, it would be the higher low. Okay, if you missed that trade, look for the higher low. So your optimal entry is from that sweep level to where those sellers are stepping in. And like we talked about earlier, you could target VWAP, you could target the point of origins, you could target higher value levels, etc., etc. Stop loss below the low. Like we said earlier, where below the low, it's kind of up to you. It's really a variable based on volatility. Just give it some wiggle room. Make sure your risk to reward is 1.25 to 1.5 or higher. Now we could take this even further. We could identify what is an actual optimal entry. Where is it too far in this zone that is no longer a good trade? It's too late to get in this buy. For example, if we missed the sweep, it kind of had a double sweep there and a higher low. If we missed all three of these entries, how late could I get in this trade and it would still make sense? If we look at just a basic risk to reward chart here, and we say our stop loss is right down here, if we enter in kind of the middle of this zone, it would give us a 1.73. If we enter at the top of the zone, it would give us a 0.8, which is very bad. If we enter on the sweep level, it would give us almost a 5-to-1, a very good risk to reward. So we could say, based on this upper portion of this zone is not optimal. It's too late. So like this breakout right here, this is too late. Okay. The reason it's too late is because our risk to reward without moving our stop loss, that is a very key point like we talked about earlier. You do not want to just move your stop loss to make your risk to reward better. That defeats the entire purpose. Okay? You need to identify where your stop loss should be, and that is locked in. Leave it there. Okay? So without moving our stop loss, our risk to reward is too low above that midpoint. It starts to go below like 1.5 to 1.25. Okay? So the optimal entry, if we wanted to be exact, is the bottom half of that zone between the sweep level and where the sellers are stepping in. It's not always going to come out to exactly the bottom half. You guys are going to have to identify that based on where your target is and where your stop loss is. Just in this example, it is the bottom half. Okay. So basically looking at this example, we want to get in where that sweep level is. That's the best. We could get in on that second retest of that sweep level, or any of this cluster right here. This higher low cluster right here is still a good entry. But as it starts to give you quote unquote confirmation and it starts to break away from that bottom, this is too late. And I talk about this very often in my tutoring sessions, where people think that they are waiting for quote unquote confirmation when the trade is kind of playing out already. But what they don't realize is when they wait for that confirmation, it deteriorates their risk to reward. Their risk to reward gets worse and worse and worse until it gets to a point where it's not even the same trade anymore. You're no longer taking a good trade. You have allowed that trade to play out so much because you think that it's quote unquote confirmation. You shouldn't even be taking that trade anymore. Okay. So for example, in this case here, once we started to see this buy pressure come in, like up here, we're like, oh, okay, it's breaking that range high. You're getting up above where the sellers were pushing us down. Now it's a good trade. It's not a good trade anymore because unless you move your stop loss, which is a cardinal sin, right? We do not want to be doing that. Unless you move your stop loss, your risk to reward does not make sense anymore. Okay? So if we left our stop loss there, our risk to reward would be 0.8 or lower. Now, the reason I identified this other point of origin level here is the only way you would make that make sense is if you said, okay, I'm no longer targeting this lower target. I have to go for a higher target now. You would have to go for a higher point of origin or a higher value level. And that's a slippery slope. When you are getting into these trades, you don't want to keep saying, okay, I'll just change my stop loss, I'll change my targets to make the trade make sense. You need to identify what makes sense right away. This is where my stop loss should be. This is where my target should be. Because then you can identify your optimal entry zone without being biased, right? Okay, so be careful with that. Okay, so finally, this part of the video is kind of foreshadowing. I'm going to be talking about some things that won't really make sense to you guys unless you understand my volume profile concepts. So once you've been through the entire series and you come back to this part of the video, it will make a whole lot more sense. But let me talk about some concepts for you guys that already understand my volume profile concepts. So a couple of big things that we can use volume profile for with market structure are failures to rotate and incomplete auctions. So let's talk about failures to rotate really quickly before we get into this incomplete auction example. So with a failure to rotate, what are we talking about? So normally we have a volume profile where we have a section of value. We have the value high, the value low. We have the upper tail, lower tail, etc. And when you are rotating, when you are going from one side of the value area to the other, that is a rotation. You are moving from one side to the other. That market structure is very neutral. You don't have a bullish aggressive market. You don't have a bullish responsive, and same for the bearish side. The buyers and sellers are kind of in they're in agreement that this is fair value. They like this value. And they're just going back and forth. Okay, it's very neutral. So what is a failure to rotate? Well, obviously, if a rotation is from one side to the other, a failure to rotate would mean that we do not make it to that other side. Maybe we stop a little bit early. Maybe we stop at the POC or VWAP or whatever we have in the middle. So we stop early and then we go back down or go back up, right? In this case, let's say we are rotating from the value low to the value high, but then we fail to rotate and we start to go back down. Why I wanted to talk about this in the market structure video is because this is a very key example of a market structure shift. Because our structure was very neutral. It was very 50-50. Back and forth, back and forth, back and forth. No one side is in control. If we fail to rotate, in this example, bearishly, what is happening? We were supposed to go up and continue that buy pressure to the value high, but the buyers got very weak. So if we identify where the clusters of candles are, this would be putting in a lower cluster. It is putting in a lower high. And that normally will be enough to shift your market to a lower low. So if we identify that next cluster compared to the prior cluster that was on the value low, that would be a lower low cluster after a lower high cluster. So these failures to rotate identify a key point of origin that starts to shift the market. Okay, that failure to rotate could turn into a very aggressive sell, which creates a point of origin. It creates a lower high, and then your market structure goes from being neutral to being bearish. Now, whether that's bearish aggressive or bearish responsive, we'll get into that later. We'll get into that on the volume profile video. That doesn't matter. But what you're looking for is that failure to rotate turning into a market structure shift. The same goes for the buy side. If we're rotating from the value high to the value low, but we stall early and we start to bounce off that POC or just anywhere above that value low, it is a failure to rotate and the market structure is shifting to the buy side. That could create a point of origin, and then we shift into higher value. The clusters, if we found them on the chart, are most likely putting in a higher high and higher low structure now, instead of a neutral structure where they're just going back and forth. All right, now that we understand failures to rotate, let's talk about incomplete auctions, because incomplete auctions are basically a failure to rotate. The big difference is with an incomplete auction, instead of rotating back and forth on the same day's value area, once again, this will make more sense later in the series, but instead of rotating back and forth on the same day's value area, it's retracing into a prior day's value area. And it's also failing to finish that retrace. So for an incomplete auction, you want it to, let's say for this example here, a bearish retrace, you want it to re-lose that value high and then go all the way back down to that value low to finish that rotation or finish that retrace entirely. If it stalls early and it starts bouncing, if it closes like that, whatever part of the value is remaining that was not filled in, that becomes an incomplete auction. And basically what you can say is it was a market structure shift. because the value was supposed to go back down and hit that value low. The bears were supposed to continue that trend and push it back down into that value low. What stopped them from doing that? There was a market structure shift there, right? They started going from lower lows and lower highs into a higher low structure to not finish going down to that value low. So in this case here, the lower low, you can see lower lows, lower highs. We turned into higher lows and higher highs. So it's local higher highs for a bit until it actually starts to see a lot of follow through. But locally, you're putting in higher highs. You're breaking the prior bars highs. You're breaking the prior cluster highs. You're shifting from a lower low structure into very clearly a higher low structure. And then finally, we see that follow through a little bit later on. Now, this is not like an exact trading technique. You're not really taking a lot of trades based on this. It's really just identifying where that market structure shift is occurring. Now, you can take trades off of this if it's happening and you're like a swing trader, right? You could be taking a trade, putting your stop loss below the value low, and then looking for a return back to the value high, possibly a breakout and a follow through above that value high. But for the most part, if you're scalping or day trading, you're just using this to identify where the market structure shift is happening so you can be on the right side of the market trend. If you're seeing that a bearish trend is shifting into a bullish trend, then you're like, okay, now I can see the buyers are in control. Now are the buyers being aggressive or responsive? Let's take a look at these clusters and kind of see what's going on. But basically with an incomplete auction, like I said, it's kind of a failure to rotate, but it's using the prior day's value instead of just your current day's volume profile. All right, guys, I appreciate you all stopping by for this video. I appreciate you guys sticking to the end. In our next episode in this series, we will be talking about indicators. We'll go more into the 8 and 24 moving average technique. We'll go more into the VWAP technique with traps and bull flags and bear flags. We'll talk a lot about the DBT Momo and the Oasis trading suite and how to use all these indicators as confluence for our different type of trades that we are looking for. Finally, before we go, one last time, just a little reminder for the giveaways. Be sure to be subscribed to the channel, be actively using Apex code BREW. Make sure to comment on these videos. We will have 5 videos, so each comment below the video will be worth 1 ticket. Provide Apex receipts using code BREW up to 20 tickets. The only exclusion is the 25K accounts. If you're a Discord member, you automatically receive 10 tickets. Make sure to email your tickets to giveaway.dejabrutrading@gmail.com, and I will be giving away Apex accounts, Discord access, and a very large giveaway with a laptop at the end of the series. Be sure to check in on the Q&A for this video on the following Monday. Be sure to hit that like button and subscribe, and I'll be seeing you guys in the next one. Peace, everybody.